Welcome to Whole Mindset Mastery. My name is T. Today's topic is how to legally pay $0 in federal taxes. The rich knows this, and I'm about to show you how. Every year, the government publishes the following year tax bracket around November timeframe. And the tax bracket are both for ordinary income tax bracket as well as the capital gains tax bracket. If you take the time to understand how this works, you can use that to your advantage. Ordinary income taxes between 10% all the way up to 37%, whereas capital gains tax at 0% and only up to 20%, with only 3 different tiers. This is why the rich gets richer, because they understand how tax system works. I will walk you through different scenarios, different filing statuses for tax year 2024, which will be filed in 2025. So the scenario I'm looking at is for tax year 2024, filing status single, head of household, married filing jointly. So scenario 1 is a single person making $35,000 a year. That's about a $16.83 per hour. Gross pay of $35,000. Taking the standard deduction of $14,600. That leaves the individual $20,400 in taxable income. The second scenario is head of household making $70,000 per year. That's about $33.65 per hour, $70,000 per year. Head of household standard deduction for 2024 is $21,900. So subtract that from the gross income. Taxable income for this individual is $48,100. For this scenario, this couple, one person makes $45,000, the other person makes $35,000. That's a combined of $80,000 per year. The first person makes $21.63 per hour. The other person makes $16.83 per hour. For 2024 married filing jointly, standard income is $29,200. So minus that, now the taxable income is $50,800. And the other scenario, the last scenario I'm going to look at, is married filing jointly, a little bit at a higher income bracket, combining of $100,000. The first person makes $65,000. The other person makes $35,000. Person 1 makes $31.25 an hour. The person 2 makes $16.83. One thing to note to keep this video fairly short, I'm only covering a portion of the whole tax system, which is the taxable income portion. The other deduction outside of the standard deduction that I use for this example are not discussed. So deductions are taken out before taxable income, and the credit, which is applied after the taxable income, that's also not discussed here. This is just strictly looking at the taxable income portion of the whole tax system. Before I actually go over the calculator, I just want to say that there are a ton of free information. There are a ton of free calculators on the internet that you can look at. But I built this one to allow you to see visually how the IRS tax ordinary income versus capital gains differently. In America, we are a progressive tax system. Your income is bracketed, and depending on where it falls, it gets taxed at a different rate. For ordinary income tax bracket, that's anything that's earned income, wages, salary, bonuses, or unqualified dividends, or real estates, etc. We have 7 tax bracket, starting at 10% all the way up to 37%. For the long-term capital gains tax bracket, we only have 3. 0% for the lowest, 15%, and 20%. Long-term capital gains are profits sold from assets like bonds, stocks, and real estate that you held for more than 1 year, or qualified dividends. Short-term capital gains, which is asset that you sold that you held for 1 year or less. And short-term capital gains is taxed the same as the ordinary income tax bracket. You look at the note above, this calculator only calculates taxable portion of the whole tax system. Tax deduction applied before and tax credit applied after, along with net investment income tax, NIIT, are outside its scope. Net investment income tax is out of scope because for my intended target audience, low to middle class, including me, we don't make that much to get additional 3.8% in taxes. For 2024, a single filer, if you make between 0 to 11,600, you get taxed at 10%. Anything above 11,600 up to 47,150, you get taxed at 12% for that amount. Anything above 47,150 up to 100,525, you get taxed at 22%. And then anything above 609,351, you get taxed at 37%. For the capital gains, your profit from 0 all the way up to 47,025 gets taxed at 0%. From 47,026 all the way up through 518,900, you get taxed at 15%. Anything from $518,901 and above, you get taxed at 20%. Single filing jointly, we still have the same 7 tax bracket for the ordinary income. We still have the same 3 different tax bracket, but the difference is the amount between the minimum and the maximum for each of the tax bracket. Same thing with married filing separately, and then head of household. And 2025, which is already released because it's November, for 2025, single filer went up by a little bit to account for inflation. First, let's start with the first scenario. This is a single filer in 2024. The taxable income was $20,400. Keep in mind that's after applying the standard deduction of $14,600. I have 2 different scenarios here. One is calculate and compare ordinary income tax and long-term capital gain tax. So what that means is the filer only has ordinary income or long-term capital gains, not both. It's calculating the ordinary income tax versus the long-term capital gain. The other scenario is stacking long-term capital gains and ordinary income tax. So this filer has both ordinary income and long-term capital gains. In this case, I would fall under that category. I had both ordinary income as well as long-term capital gains. The way stacking works is your ordinary income will go first, and then your long-term capital gain will stack on top of that. So depending on how much you make in ordinary income, it may push your tax bracket in the long-term capital gain higher. Let's show an example. For that person that makes $20,400, the first $11,600 is taxed at 10% because it falls under this range. That's the tax liability. The next $8,800 get taxed at 12%. That's $1,056. That put the person at 12% marginal tax rate with tax liability of $2,216. That's an effective tax rate of 10.8%. So the difference between marginal tax rate and effective tax rate is the top bracket in which you get taxed. The effective tax rate is the amount taxed divided by your taxable income. So even though your top bracket is 12%, your effective tax rate is 10.8% because a portion of it was taxed at 10%, not the full amount. Another person can have no ordinary income at all, just strictly an investor. They have up to $47,025 to get taxed at 0%. If they profit the same amount, they don't get taxed a penny. They can pool as much as $47,025 without having an ordinary income. They still don't get taxed a single penny. If they pool more than the 0% tax bracket for the long-term capital gain, let's say $50,000, then the first $47,000 is still taxed at 0%. But anything above that, up to $518,900, is taxed at 15%. And then the next $2,975 is taxed at 15%. So that's $446 in tax owed. That's only $446. This person may be at a 15% tax bracket, but the effective tax rate is 0.89%. Only $446 in taxes out of $50,000 in capital gain taxable income. This comparison is one or the other, either the W-2 wage income earners or the investor. If this person happened to be working and also investing and have profit that they can realize asset they held for more than 1 year, they can realize that profit up to, in this case, $26,625. Oops, $26,625. Ordinary income plus long-term capital gains, taxable income, stacking taxable amount is $47,025. The ordinary income piece is still the same, but if you look at the long-term capital gain, $26,625 is taxed at 0%. If they pull more than the 0% bracket, let's say $30,000, the first $26,625 of the profit is still taxed at 0, but anything above that fall under the 15% tax bracket. So $3,375 is taxed at 15%. So tax liability for that portion is $506.25. One thing to note, even though profit is $30,000, which is still between the 0 and $47,025 at 0% tax, the full $30,000 is not taxed at 0% because of the stacking order. The IRS stacked the $30,000 in profit on top of the $20,400 to evaluate where you at within the bracket. So $50,400 is $3,375 above the max allowed in the 0%. So the next one up is 15%. So they use the stackable amount to determine what bracket you are in, but when it comes to the taxable amount, it's up to your profit. I hope that makes sense. Even in that case, you still owe very little in taxes. Next scenario is head of household with a gross income of $70,000 minus the $21,900 standard deduction. So taxable income is $48,100. If I just look at the compared portion of it first, one scenario, the person is head of household with a taxable ordinary income at $48,100. A different filer has the same $48,100, but it comes from profit. If you compare the two, the person that works, tax liability is $5,441, marginal tax rate 12%, effective tax rate of 11.31%, while the investor, only source of income is the profit, all $48,100 is taxed at 0% because it falls between $0 and $63,000 at 0% for the long-term capital gains. Of course, this person can also have up to $63,000 and still be at 0% tax. Let's look at the stacking scenario. This filer has both the ordinary income as well as the capital gain. This person can realize up to $14,900 to take advantage of 0% capital gains. So they can sell profit up to $14,900. That put them the stacking taxable amount of $63,000. $48,100 plus $14,900 equals $63,000. The ordinary income piece, they owe $5,441. That puts them at 12% marginal tax rate. The effective tax rate is 11.31%, owing $5,441 out of the $48,100 taxable amount. The stacking piece, the capital gain piece, the $14,900 get taxed at 0%. So effective tax rate is 8.64%. Total tax liability, $5,441. Next up, married filing jointly. This person's gross income is $80,000 minus the $29,200 standard deduction. So taxable income for this scenario is $50,800. The first $23,200 taxed at 10%. The next $27,600 taxed at 12%. Total tax liability $5,632. Marginal tax rate at 12%. Effective tax rate at 11.09%. Federal tax liability $5,632 out of the $50,800 taxable amount. If another filer profit the same thing, and that's the only source of income that they have, again, 0% tax for that full amount. They can pull up as much as $94,050 for merit filing jointly. And for a different filer who currently works and invests with a taxable income of $50,800, they can realize additional $43,250 to legally take advantage of the 0%. $0 tax. If they pull a little bit above the $94,050 threshold for the 0%, just the additional amount would be taxed at 15%. So if they pull at $50,000 instead of $43,000, the first $43,250 of profit is still taxed at 0%, and then the $6,750 is taxed at 15%. So total tax liability is only $1,012 for the capital gains. And that brings total between the ordinary income tax plus the capital gain tax total to $6,644 with effective tax rate of 6.59%. As a reminder, the way IRS calculate stacking long-term capital gains on top of ordinary income, it uses the full taxable amount for ordinary income plus the capital gains taxable amount, that's $100,800. It uses that to determine what bracket you're in, but the taxable amount is the actual profit itself, $50,000 total. The next scenario, this couple makes a total of $100,000 minus a $29,200 standard deduction. Taxable income is $70,800. Again, if a different filer makes the same amount, but only from investing, 0%. A third filer with the same status, the same amount, but they also work and invest, they can realize up to $23,250 of profit. Still get 0% tax for that amount. Taxes was a big topic in the presidential campaign, and I won't get into any politics on this channel. What I want you to think about is eliminate all the noise and take the time to read up on the facts. Go straight to the source, the IRS, and read on different blogs, watch different YouTube to understand how our tax system really works. If you understand how progressive tax system works, how our income is taxed based on the income bracket and have different marginal tax rate, we have 7 different tax bracket for ordinary income and 3 different bracket for capital gains. Ordinary income taxes between 10% all the way up to 37%, whereas capital gains taxed at 0% and only up to 20%, with only 3 different tiers. This is why the rich gets richer, because they understand how tax system works. Our tax code is like professional sports. Every professional sport have rule books, from NCAA to the NFL to the NBA. You have different rules for the plays. You have rules for how many teams are allowed in the playoff. NCAA now has playoff system, but prior to that, they didn't have playoff. And then with the playoff, now people want more teams into the playoff. So with any rule, you're not going to satisfy everyone. So same with NFL rulebook, NCAA, NBA, all the professional sport. Every teams, every owners, and every coaches must follow those rules and follow those guidelines. They are published before the season starts. Whether you agree or don't agree with it, it is a rule. In this case, our tax system, whether you think it's fair or not fair, it is published a couple months before the next year, and you know exactly what tax rate each of the income bracket falls under. Take the time to read it, understand it, and leverage it. You don't have to agree with it. The same tax system that the richest use, we can leverage the same system. It's for every American. You may be at the point where you can actually start to leverage some of these, where you can be like me who earn income as well as an investor. Depending on the income, some years we can harvest the profit without taking additional hit on the taxes. There are years that we can't. On traditional media and social media, you hear a lot about retirement account, tax sheltered, tax-deferred retirement account. Take advantage of those and try to stay away from taxable individual brokerage account because those create a taxable event. But the advice that you hear on those channels are mainly geared toward the higher income bracket. But for low to middle class, we don't make enough to exceed those brackets. So we do have some opportunity to harvest our profit without any taxes on those profits, on those gains, if we hold it for more than 1 year. And there are ways that we can change our taxable income by contributing more to retirement account that reduces the taxable income. But that's a different topic on a different video. Let's fast forward to 20 years from now, and you happen to be an avid investor, and you have $2 million, and you are not at the point where you can pull money from 401k yet. Let's say you're only 50, and in order to withdraw from 401k is 59.5. In order to withdraw from Roth IRA is also 59.5. So you still have many more years to go yet. But you have $2 million in individual brokerage account outside the retirement account. What that means, if you do the 4% withdrawal rule, that's $80,000 per year. 4% of $2 million is $80,000. Let's say you mirrored filing jointly. You don't know what the tax bracket will be at that time. You don't know what standard deduction will be at the time. Let's assume it's the same as it is in 2024. And then you retire and you don't work anymore. You don't have any form of income outside of your profit. Let's say you pull $80,000 and you mirror it filing jointly, assuming 20 years from now it's still the same tax bracket as this year, but you know that's not true. But let's play with me for a little bit. You can pull $80,000 without any other form of income, just from profit from your investment outside your retirement account. You still get taxed at 0%. Actually, now let's make it even more impactful. What if you pull, let's say you take advantage of the full 0%. $94,050 of capital gains taxable income is still taxed at 0%. Keep in mind that $94,050 is without the standard deduction. If you add the $29,200 to it, that means you pull $123,250 in profit. I will sprinkle a little bit here and there on the why I do this full time, even though I'm not getting paid a single dime. Because to me, knowledge should be free. I understand companies should make money. I understand, people in the business that make money. And when you add value, you should be paid accordingly. But how much is enough? How much is enough? You have companies that make billions and still take more from the people that need it. And then you have influencers that claim to have the secret recipe to investing. So they charge you this master course. And if they have, let's say, 500,000 followers, all it takes is 1 or 2% of followers to buy the course. Now, who's making the millions? I understand there is some situation where looking at the resources, reading it, watching the material is still not enough, where you need some hand holding. In that case, that's okay, that's fine. But I want that to be the last resort. Before you pay anyone, any gurus, the master class, all that stuff, find the article or the channel that give you some valuable information, not just selling you information. Unfortunately, it's a needle in a haystack. Oftentimes you see people giving you just enough, and then if you want more, you have to pay for the masterclass. The rich do get richer because they understand the tax system and they leverage it. What I ask from you is whether you agree with the tax system or not, whether you think it's fair or not. Read it, learn it, understand it, and apply it. The same tax code that the rich are using is published that we as an average American can do the same. Now, tax code is massive, right? Tax code is massive. Even someone like me who understands the tax for what I do, when I feel TurboTax answering those questions, it makes me confused because the question it asks is like, what is this? It doesn't apply to me. But if you narrow down and simplify it, 98% of Americans can fill the tax with just an index card. But that's a different video on a different day.